Welcome to Fintech Quotient Pulse, your go-to source for quick and insightful updates on the latest happenings in the world of fintech. I am Ronak Dembla, and in today's episode, we are breaking down a recent move by the RBI that could reshape the lending landscape. The RBI has increased the risk weight for unsecured consumer loans, credit card exposure, and loans to NBFC by 25%. Let's delve into the reasons behind this move and its potential impact. This move seems to stem the burgeoning growth of unsecured credit in India over the last couple of years. Also, this move comes on the back of a lot of regulatory activity and penalties by RBI targeting banks and large lenders. Let's look at possible reasons and triggers for RBI to make this move. Firstly, according to a CARE research report, unsecured loans as a part of the overall retail loans has increased steadily over the last few years. In June of 2020, unsecured retail loans stood at about 28.2% of the overall retail lending pie. In February of 2023, it has gone up to 31.6%. With easy access to personal loans and credit cards, RBI could be worried about a large part of the society getting into debt. Second, lenders have increased unsecured loans despite RBI making their displeasure known. I have collated a list of year-on-year growth of unsecured loans of multiple lenders. ICICI Bank's personal lending portfolio has grown by 40%, Kotak Mahindra's by 35%, Axis Bank's by 25%, and Bajaj Finance's by 22%. Furthermore, banks and lenders have flouted RBI's KYC muster directions and digital lending guidelines. RBI has fined banks like ICICI, Mahindra and Mahindra Financial Services, Paytm Payments Bank, Kotak Mahindra Bank, Canara Bank, Jammu and Kashmir Bank, and L&T Finance for non-compliance in the last 6 months. An interesting development is where RBI first fined the Bank of Baroda 30 lakhs for not complying with KYC norms. With that not being fixed, RBI ordered Bank of Baroda to stop onboarding new users on the Bob World app. And RBI fines have gone up from about 14 crore last year to about 51 crore till the second week of November this year. This is just a reflection of the state of mind that the RBI is in currently. So very clearly, RBI seems to be irritated with what's happening. What are the banks and lenders thinking though? According to banks and lenders, they claim to be vigilant and are okay with the risk build-up since the ticket size is typically on the lower side at about 50,000 rupees on average. So what did RBI do? They did what they thought would safeguard the system from possible losses and defaults. They increased the risk weights of different products for banks and NBFCs. Let's understand risk weights in detail. Risk-weighted assets is the minimum amount of capital that lenders must have with the risk profile of their lending activities. This increases the amount of capital needed by the lenders to lend. Lenders decide how much they lend based on these formulae. Typically, secured loans require lower risk weight and therefore lesser capital to be kept aside. So theoretically, a lender can lend more from the same deposit base for secured loans like home loans, gold loans, etc. as compared to unsecured loans. Let's look at the numbers and how they stack up. The risk weights for commercial banks, NBFCs on consumer credit used to attract a risk weight of 100%. This has now been increased to 125% on outstanding as well as new loans. Credit card receivables of scheduled commercial banks used to attract risk weights of 125%, which has now been increased to 150%. And NBFC credit card outstanding risk weights have been increased from 100 to 125%. What is the impact of this move now? Let's get into it. Firstly, banks and lenders have to put more capital aside. This means that they have lesser money to lend, or they could focus more on secured loans instead. Second, there are lenders in the market who have a good mix of secured and unsecured loans, like HDFC or SBI, who have a robust secured loan portfolio, and they will not be impacted much. Third, There are standalone credit card issuers like SBI cards and NBFCs who partner with fintechs for personal loans, who I believe will bear the biggest brunt of this move. Fourth, this will increase the cost of capital for all lenders and fintechs since more capital has to be put aside into non-interest generating pools. Fifth, fintech lenders will now have lower margins and will need more capital to lend as much as previous levels. In this funding winter, equity funding is hard to come by and will stem the amount of money being lent. It will be harder to continue lending at existing rates. This despite a series of rate hikes by the RBI making loans quite expensive. With the new rates, it's going to make personal loans costlier for borrowers and make it difficult for lenders to increase the percentage of unsecured loans in their portfolio. Fintechs will face the heat too, since their lending partners will have to provision for the new capital adequacy requirements. Ultimately, all costs get passed over to the borrower. It will be fascinating to watch how different players like banks, NBFCs, and fintechs react and navigate through this phase. And there you have it, folks, a rapid rundown of the latest in fintech on Fintech Quotient Pulse. Numbers, insights, and everything you need to stay in the know. If you found today's episode valuable, hit subscribe, rate us, and share this episode with other fintech enthusiasts. We will be back soon with more deep dives into the world of finance. Until then, let's build the future of fintech together.